Another exclusive: if you are an EPFO member, then calculations for you might be set to change. CNBC TV 18 learns from sources that the Employees Provident Fund Organization, in its meeting later this month, will deliberate on some crucial points regarding exit and investment policies. What does this mean? Yash Jain is here with more details. Yash, we believe there are 3 exit options broadly that are being considered. Take us through them.
Well, the retirement body EPFO in its scheduled meeting is likely to discuss 3 very crucial schemes in order to ensure a timely exit from its ETF investments and also to optimize returns for its 17 crore EPFO subscribers in the country. Now, if you look at these 3 schemes, under the first scheme, EPFO is likely to provide an investment option or choice of investment to its subscribers in terms of debt investments, equity investments, or a mixture of both versus the current mechanism where EPFO takes investment calls on behalf of its subscribers. So that will be a very important call which we'll look out for. Under the second scheme, EPFO is likely to provide mark-to-market returns to its investors versus the current procedure where it provides a fixed interest rate on the EPF contribution which it receives from its subscribers. The third and the last one, but the most important one, I would say, would be the policy which decides EPFO's exit mechanism. Now, EPFO is considering an exit or selling its ETF investments depending on the realization of profits. Now, how would this scheme really work? Under this scheme, in the first step, EPFO would move and identify a floor profit or a minimum profit which it would expect from its investments in the ETFs. The second step, over a considerable amount of time, would be to analyze the accrued profit or the profit which it has realized over a period of time. And in a situation where it would want to sell its ETF investments, the proportion of selling or the quantum of selling would be corresponding to the difference between the accrued profit and the floor profit which it had set earlier. Now, just to help you understand this better, I would put numbers to this particular example. Now, if the floor profit which is assumed is 8% and the profit accrued is 9%, the difference would be 1%. And according to the formula which has been suggested by EPFO, the number that you would lead to is 11.11%, and that would be the quantum of dilution or stake sale out of the ETF stake which EPFO has in this particular situation. Now, we are given to understand that all these 3 important amendments will be discussed in the June end board meeting, and post that they will be taken up with the fund managers of EPFO, which includes SBI MF, UTI MF, for the next leg of implementation.